In this video, I will be covering a few loose-end wrap-up topics related to the allocation and depreciation of differences between implied and book values. Remember that goodwill is not recorded on the general ledger in a consolidation. It's actually allocated, just like our fair value adjustments. Therefore, when it's impaired, we will need to depreciate that allocation in the same way we did our fair value adjustments. We will also need to adjust our calculation of the non-controlling interest share of net income to include any adjustments to our allocations that impact the subsidiary's current year income statement. Items that we might need to adjust for include depreciation, cost of goods sold, or the previously mentioned goodwill impairment. Let's look at our example where we will follow our eliminating entries all the way through to the worksheet and perform this now more complicated calculation of non-controlling interest income. In this example, we will be continuing the case that we were following in the previous video. We had been following this same transaction through the equity method 2 videos ago. Then in the last video, we were using the cost method. So in this video, we're actually going to continue the cost method into year 3. So this is the exact same transaction we were doing before. Our computation and allocation of differences schedule is identical to what it was before because it's as of the date of acquisition, so we don't need to redo it. But we do have some additional information down here. We have a new trial balance of our parent company and a new trial balance of our subsidiary company because we are going to put together the full worksheet this time, which I have open on the right-hand side of the screen. This trial balance is already arranged into our financial statements. So we can see we have the income statement on the top, we have our retained earnings statement here, and we have our balance sheet at the bottom. So our task here is to prepare a consolidated financial statements work paper for year ended December 31st, 2015. Although no goodwill impairment was reflected at the end of 2013 or 2014, the last 2 examples we just did, the goodwill impairment test conducted at December 31st, 2015 revealed implied goodwill from Salem to be only $150,000. The impairment has not yet been recorded on the books of the parent. And they're just reminding us that we are going to continue using the cost method in this example. Okay, so again, just like when we were doing this one before, we still have no intercompany transactions. So we would need to read through all the material and see if they talk about doing business with themselves. In this case, they don't. Our next one is to eliminate any current year income from of the subsidiary recorded by the parent. Since this is the cost method, we know that they didn't do that. That's something that happens during the equity method. We do, however, have to do our entry to establish reciprocity or convert cost to equity. So again, first thing we want to do is check and see if the retained earnings of the subsidiary has increased from the date of acquisition to the beginning of the year that we're consolidating. So we know on the date of acquisition, it was $80,000. And if we come down here, we see that on the beginning of this year, it was $230,000. So we know that it's increased over time. So when it has increased over time, that means that if we had been using the equity method, our investment in S would be bigger now than it was on the date of acquisition. So we're going to increase investment in S, and we are going to credit 1/1 retained earnings of our parent. Now, if for some reason the retained earnings of the subsidiary had decreased since acquisition, we would switch our debit and our credit here. Our actual amount is going to be our share. So in this case, we have an 80% share of the change in retained earnings. So we want to know from the beginning of the current year minus what it was on the date of acquisition, which we'll always be able to find in our computation and allocation of differences schedule. So again, keep in mind that now we're looking at changes from year 2 and year 1. When we did this entry in the previous video, we were only looking at changes from the prior year, but that's only because there was only 1 year since acquisition. This catch-up entry is always going to catch up that change in retained earnings from the date of acquisition all the way through the beginning of the year that we're consolidating. Okay. Then for our next entry, we need to eliminate any current year dividends the subsidiary paid to the parent. So regardless of method, we know our credit is going to be dividends declared by our subsidiary. And then our debit is going to change depending on if we're using the cost or the equity method. Here we're using the cost method. So when we initially recorded these dividends, when we received them as the parent, we would have recorded dividend income. So that's what we need to eliminate. All right. We know that we got 80% of whatever the subsidiary declared. And if we come up and look at their trial balance, we see that dividends declared was $60,000. So 80% of that would have come to us as their 80% shareholder in the parent. So that means that we would need to eliminate $48,000 of dividends because we can't pay dividends to ourselves. Next entry is our entry to eliminate our subsidiary equity accounts. So as always, I'm just going to set this one up first. So we know we need to get rid of our investment in S and any subsidiary equity. In this example, we had 2 equity accounts, common stock and 1 retained earnings of our subsidiary. We don't own 100%, so there will be a non-controlling interest that we need to establish. And our difference between implied and book was positive, so that's going to be a debit. Okay, now our difference between implied and book does not change over time. So we know that if it was $432,500 on the date of acquisition, that's still what it is. Our common stock also doesn't change just because our book is nice to us and doesn't make us deal with that particular situation. And we know retained earnings is going to change over time. So in the last couple examples, we had to calculate it ourselves. But in this case, they gave us a trial balance. So we want to eliminate whatever retained earnings of the subsidiary was at the beginning of the year. That's this number right here. So we can just pick that up. We don't have to recalculate it. Now what we're going to do is we're going to take any increase in retained earnings since the date of acquisition and allocate it between investment in S and non-controlling interest. So we're going to take our initial investment in S, which was $850,000, add to that our share, or 80%, of the increase in subsidiaries' retained earnings. So we're going to take whatever retained earnings is in this eliminating entry right here. We're going to subtract out what it was on the date of acquisition, which we can find on our computation and allocation of differences schedule. And that will give us our new value for investment in S in this eliminating entry. Same thing for non-controlling interest. So we're going to take our initial amount of $212,500, add to that their share, or 20% of that same change. So that's whatever retained earnings we just calculated and put in our eliminating entry, minus what it was on the date of acquisition, which can always be found in our computation and allocation of differences schedule. Again, remember, this entry will be the same under both the equity and cost methods. Next, we're going to allocate our difference between implied and book. And because we are allocating this as according to our computation and allocation of differences schedule, this is not only going to be the same whether we're using cost or equity, it's also going to be the same every year because we are first doing whatever we did on the date of acquisition, and then we're going to update it afterwards. So our allocations here were equipment, land, inventory, and goodwill. So we needed to increase the value of equipment, land, and inventory and establish our goodwill. So equipment was $130,000. Land was an increase of $65,000. Inventory was an increase of $40,000. And we established goodwill of $197,500. Okay, so now we're going to go through each of these items and see what adjustments we need to make. So equipment, we've been adjusting that one for the last couple of years. We know that because it's year 3 and we're depreciating it for 5 years, we need 1 year's worth of depreciation expense on our income statement. So that amount, that fair value adjustment, is being depreciated over 5 years. So 1 year's worth is $26,000. We also know that we have 2 years worth of depreciation expense that passed through prior year income statements. And we're going to split that amount between the parent and the non-controlling interest. Because this is a cost method example, the parent portion is going to go to 1/1 retained earnings of the parent, and the non-controlling interest portion always goes to non-controlling interest. So again, we're going to take 2 years worth, because we have 2 years that went through past income statements, times the annual amount of depreciation, times our ownership percentage of 80%. Then we're going to do the same thing for the non-controlling shares. We're going to take 2 years worth of the annual amount times their ownership percentage of 20%. So we've just taken 2 years worth of depreciation expense and split it 80-20 between these two. Then we're going to take this amount out of our equipment net account, and that should be a total of 3 years worth of depreciation expense. Next, we have land. We didn't sell it, and you don't depreciate it, so we don't have to worry about that one. Inventory, we sold, but we sold it in a past year. So we're going to adjust it by taking inventory off of the balance sheet in the amount of $40,000. And since it all happened in a prior year, we're going to split it 80-20 between our 1/1 retained earnings of the parent and our non-controlling interest. So that's $32,000 versus $8,000 for our non-controlling interest. Then finally, we have goodwill. And so goodwill, they told us, had been impaired because its fair value, or its implied value is now only $150,000. So it's on the books for $197,500, which means we need to impair this. So we're going to record an impairment loss on our income statement, and we're going to reduce the amount of goodwill on the balance sheet. Since this is on our current year income statement, we don't have to worry about splitting this between the parent share and the non-controlling share. The amount here is going to be whatever brings our current balance, which is $197,500, down to $150,000, which is what we want our balance to be, which means we need to record an impairment loss of $47,500. So now that we have our eliminating entries, we're going to move over to our worksheet and start putting them into this format so that we can get to our last new thing, which is adjusting our non-controlling interest income. So entry number 1, we don't have anything there. Entry number 2, we need to debit our investment in S for $120,000. You'll see that once I do that, that's going to trigger all of our formulas to come online and start calculating our consolidated totals so you can kind of watch it in real time. Then we have a credit to 1/1 retained earnings of our parent for $120,000. Please notice the way I have this set up is that we're going to have multiple entries coming to 1/1 retained earnings of our parent. So all 4 of these cells work into our formulas on our consolidated column. So we don't have to use our cells for more than one entry. We can see everything that's going on. Okay, so again, we should be able to check down at the bottom, our debits equal our credits. So we entered that correctly. Then our next one, we're going to debit dividend income. That's going to be up on the income statement. So this is entry number 3. We are going to debit it for $48,000. And we are going to credit dividends declared, which we will find down here, for the same amount. And remember, that's dividends declared of our subsidiary, so we need to make sure we have it on the subsidiary line, not on the parent line. Then we have entry number 4. We're going to get our common stock of our subsidiary. So again, make sure we're on the subsidiary line. And we're going to debit for $550,000. Then we have 1/1 retained earnings of the subsidiary. So we have to head back up to the retained earnings statement. That's going to be a debit of $230,000. Then we need our difference between implied and book, which once again is going to appear in the middle of everything for no discernible reason, but it doesn't matter because it's going to go away. We're going to add that for $432,500. And then we have our credits. One is investment in S for $970,000 and non-controlling interest down at the bottom here for $242,500. And again, notice that non-controlling interest is also going to have multiple entries. So they have these brackets here. Anything on both of these lines is going to go to non-controlling interest. Okay. Next one, 5A. We're actually going to start with our credit. So we're going to take our difference between implied and book, $32,500, and we're going to put it someplace else. So we're going to start with equipment, property and equipment here. We're going to increase by $130,000. Then we have land that we're going to increase by $65,000. Then we have inventory, which we are going to increase by $40,000. And finally, we need to write in goodwill. And we are going to add that in for $197,500. Now we haven't checked in for a while. We've done a few entries, but our balance sheet still balances. So it looks like we haven't made any errors yet. Okay, now we're going to do our adjusting entries here to these allocations. First one is for inventory. So again, I'm going to start with the credit. So 5B here, we're going to credit $40,000 to undo that fair value adjustment. And then we're going to go up to the retained earnings statement. And we are going to debit for $32,000. And then we're going to head back down to non-controlling interest. And we are going to debit for $8,000. Then our next entry is going to be our allocation for the equipment. So again, I'm going to start with the credit. So our 5C here, we are going to credit $78,000. And then we're going to debit depreciation expense. We have to head all the way back up to the top. See, for $26,000. Then we are going to head back down to 1/1 retained earnings of the parent. And that's going to be $41,600. And then back down to our non-controlling interest, which will be $10,400. Okay, still balance, still looking good. Going into our last entry. Now this one I've labeled 6, but it could easily be 5D. Not sure why I decided to do it that way. So again, I'm going to start with the credit. Our credit is $47,500. And our debit is an impairment loss. So that's going to be on the income statement. We're going to head all the way back up here. We're going to need to write that in. And that's going to be, again, $47,500. So now I think we have everything in here. Going to go down here, double check that our debits and our credits match. And then we're going to maximize this so that we can take a look at our worksheet. Okay. So the part that's new here is our non-controlling interest. So before, what we did was we took our non-controlling interest share, or 20%, of their income, which their income was the subsidiary. They only own shares in the subsidiary, so they only have rights to the income of that entity. However, what we're going to do here is we're going to make some adjustments. And so what we're going to say is that we need to take a look at everything that happens up here, and whatever is adjusting the subsidiary income needs to be taken into account when we calculate this number. So this first one, what's that entry doing? Well, it's eliminating dividend income. Who has dividend income? The parent company. So we're not adjusting the subsidiary's income with this. We're adjusting the parent company's income with this. So we're going to ignore that one. But this one, what are we doing? Well, here we're increasing the amount of depreciation recognized by our subsidiary. So this is going to change our subsidiary income. So what we need to do here is we need to make sure we take that adjustment into account. And so in this case, that's extra depreciation. That's going to be income decreasing. So we're going to subtract that amount. So that's going to make our income from the subsidiary a little bit lower. Now we have one that's left, which is our impairment loss. Now that impairment loss is related to goodwill from the acquisition of the subsidiary. So that goodwill is attributable to the subsidiary. If the subsidiary loses value, that's when goodwill is impaired. So that impairment loss also impacts the subsidiary's net income. So we are also going to reduce the amount of income attributable to the subsidiary by that impairment loss. So that means that the non-controlling interest share of income is actually $19,300 after we've made these adjustments. So that'll flow down here. We will add in their dividends, which it looks like we actually have an error down here because we should see right here, this number doesn't make any sense, right? So let's take a look at where we went wrong. This entry right here should be our subsidiary company's retained earnings. So right off the bat, we should have noticed that this number here doesn't make any sense. For the subsidiary to get that much dividends makes no sense. So we must have had an error. So we're going to move this guy up to where it should be. Take it out of there. That looks better. So our subsidiary had $19,300 of income attributable to the non-controlling shareholders and $12,000 of dividends attributable to them. So that means their investment increased in worth $7,300 during this year. That comes down, gets added to our beginning balance, and comes over here to our consolidated balance sheet. Again, let's do a few checks now that I know there's one mistake in here, make sure there aren't any others. We had dividend income from our that our parent had recognized. It looks like that was all from our subsidiary, and so it's all been eliminated. We also had depreciation expense. We increased that amount for this extra depreciation of our fair value adjustment, and we also added an impairment loss. That's all what we intended to do, so that makes sense. Then when we come down here, we have some additions or adjustments to our parent retained earnings due to those fair value adjustments that happened in prior periods. We have our elimination of our subsidiary beginning balance of retained earnings, which was our error that we caught as we were putting in our non-controlling interest income. And then we have our subsidiary dividends, which we're eliminating the portion paid to us as a parent, and we're keeping the portion paid to our non-controlling shareholders. So looks good so far. Then down here, we can see that since the inventory was sold, we have no fair value adjustment because we canceled that out. We also see that our investment in S has been fully eliminated. This was our entry to establish reciprocity. Remember, had we forgotten to do that, we would have ended up with a negative amount in our consolidated column, which should be a red flag. Our difference between implied and book has been fully eliminated, so that's good. We don't want to leave any of that hanging around. Our land got written up to its fair value and then not adjusted since. That's what we wanted. And we've taken some portion of the $130,000, 3 years worth of depreciation out, and impaired our goodwill so that it's a balance of $150,000 like they told us it should be. Then our other side of our balance sheet's pretty boring. We got rid of our subsidiary common stock, and we have our non-controlling interest with their share of those income adjustments from prior years and adjusted for their share of income and dividends from this year and our balance sheet balances. So we've done all our checks and we're pretty sure that this looks good.
One last wrap-up item that I want to mention is pushdown accounting. Notice that we finally have a blue sticker at the top of this slide. Pushdown accounting is the one time we get to make entries on the subsidiary's general ledger. Under pushdown accounting, we no longer make our fair value adjustments on the worksheet. Instead, we will adjust the subsidiary's general ledger to fair value and record goodwill on their books. This method has some similarities to an asset acquisition, but two sets of accounting records still remain. SEC guidelines indicate that if a parent owns 95% or more, pushdown accounting should be used. If a parent owns less than 80%, then pushdown accounting shouldn't be used. And in the middle, well, that's a gray area without clear guidance. In this class, assume no pushdown accounting unless told otherwise. To apply pushdown accounting to the problem we've been discussing throughout the last several lectures, we would need to record the fair value adjustments to the subsidiary's general ledger directly. We determined that as of the date of acquisition, the fair value of the land was $130,000 higher than its book value, so we need to debit equipment by $130,000 to increase the book value and make it equal to fair value. The same is true for land and inventory at their respective amounts. Under pushdown accounting, goodwill will be recorded on the subsidiary's general ledger rather than residing on the worksheet only. Once we have recorded all of our fair value adjustments and goodwill, as calculated on the CAD, we will balance the entry using an account called revaluation capital. You may notice that this amount is equal to the difference between implied and book value. This is not a coincidence. The difference between implied and book value is essentially the net amount that must be pushed down to the subsidiary. An advantage of pushdown accounting, that you may have thought of already, is that it simplifies the parent's accounting if they choose to use the complete equity method. Items like extra depreciation that occur as the result of writing the equipment up to fair value will already be included in the net income reported by the subsidiary, and no adjustments will need to be made by the parent. This concludes our wrap-up of allocation and depreciation. Don't forget to email your questions.